Thanks for clicking. Canadian insolvencies could rise by up to 30% over the next 3 years. This according to a new report coming from RBC. The report goes over the current and future financial condition of Canadians and predicts that mortgage delinquencies could rise by more than 1/3 over the next year. Yet the report comes as a number of experts are predicting an end to Canada's real estate correction, noting that continued supply challenges will continue to push prices up. But with evidence mounting that homeowners are buckling under the weight of the higher cost of borrowing, it's not clear that the rhetoric matches reality.
When has that ever stopped us?
So what I want to do today is go over the report from RBC, discuss its outlook for the Canadian economy over the next 3 years, and then go over its impact on house prices. Speaking of house prices, we are still eagerly awaiting for the national sales data for the month of April coming from the Canadian Real Estate Association, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. RBC's report begins with the premise that Canadian household debt, which retreated briefly during the pandemic, has now shot up to near historic highs. And now that the pandemic-related support measures have come to an end, cracks are starting to form. An increasing number of Canadians are falling behind on their payments. And while Canadians are continuing to make their mortgage payments, for now, which we'll get into, delinquencies on credit cards, auto loans, and lines of credit are all moving up sharply. And with the recession coming, RBC is predicting that Canada's unemployment rate will move from 5% all the way up to 6.6%, which is likely to lead to an even bigger increase in delinquencies and insolvencies. Which makes sense. When people don't have jobs, when they're not out there making money, they have trouble paying their bills. As such, RBC is predicting with the impending recession and the subsequent rise in our unemployment rate, consumer insolvencies are expected to rise by 30% over the next 3 years and continue their upward trajectory thereafter. And these delinquencies, these insolvencies, these non-payment of loans, says RBC, is eventually going to bleed its way into the housing market, with holders of variable rate mortgages already seeing a major increase in their payments, and holders of fixed rate mortgages expected to see a major increase at renewal time as well.
Welcome to your show.
Indeed, 5 years ago, a decent 5-year fixed mortgage rate from RBC was 3.74, and as of the time of this video, a decent 5-year fixed from RBC is 5.54. On, say, a $500,000 mortgage, that bump up in the interest rate will translate to an extra $9,000 per year going towards interest, coming out of the pockets of the homeowner. And this caution from RBC that the rate hikes that we've seen over the past year are about to hit holders of fixed rate mortgages is echoed in a recent Angus Reid survey, which found that 78% of holders of fixed-rate mortgages are worried or very worried about their mortgage renewal. Curiously though, holders of fixed-rate mortgages are 1% more worried than holders of variable-rate mortgages.
You my friend?
And with the Bank of Canada Governor Tiff Macklem recently announcing that, absent a financial crisis, interest rates aren't likely to go any lower for the next year, it's not clear that this is going to be getting any better anytime soon. And I think that's an important point to consider. Absent a major financial crisis, rates aren't expected to go down for well over a year, and we're already seeing delinquencies creep upwards. We're already seeing the non-payment of loans go up, holders of variable rate mortgages are already reporting major stresses, and the unemployment rate is still only sitting at 5%. While inflation has come down, we still have to get through the recessionary part of the rate hiking cycle. That part hasn't even started yet, and delinquencies are already up. And what we talked about before on this channel, that delinquencies and insolvencies will put more downward pressure on home prices as homeowners are forced or anticipatory forced to sell their homes. This will also put downward pressure on demand. In general, potential homebuyers that have had major delinquencies, have had insolvencies, have a difficult time securing an insured mortgage, a difficult time securing a mortgage with less than 20% down.
Perhaps it is time to unload that burden for the right price.
So, according to RBC, once this recession hits, we're likely to see a major increase in insolvencies, in delinquencies, which will put more supply of homes onto the market, but it should also decrease demand for homes, at least in the medium term. Given the fact that these rate hikes that we've had over the past 14 or 15 months were intentionally designed to cause a recession, and that recession, although still predicted to be on its way, has not hit yet, it's not clear that the housing market is going to be able to make a full rebound back to 2021, early 2022 levels while we're in a recession. while rates are still high and the Canadian economy is reversing. With that said, we will continue to track the progress of Canada's economy on this channel as well as this real estate market. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.